To the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, Mr. Brown. Good morning, sir.
Hey, Sip, how you doing?
Feeling a little bit under the weather. Just got back from Vegas. Vegas was fun. Today is December 8th. This is episode 110. And
Jeez.
the major headline that I saw today that caught my attention was 6 weeks of rallies. And we've been talking about that the last couple of weeks. And are you feeling that that's going to continue? What are your thoughts on the market?
No, I mean, you guys know, and I would, the way I categorize it, it's 6 weeks of the same rally, right? And it's a one-time rally, and rallies do not make up markets. That's for sure. I've been saying for weeks now, we've got actual factual quantitative analysis that tells us that there is a lot of selling that'll kick in at $4,600, and this week proved me right. Every time we get close to that $4,600 in the S&P 500, we see selling, right? So far this week, there's been just about enough buying to offset that selling, right? If there's a match of buying and selling, prices go sideways. I'm just waiting to see who wins out, the buyers or the sellers, right? One of them has to exhaust the other. Now, we're going to get into charts in a little bit, Sip, but I'll show you from a chart perspective how we can actually kind of see who's winning that push-pull battle. But we'll look at that in a second.
Yeah, and last week we touched on that 4,600 mark. I see it in the notes. I see it on the charts. Maybe before we get into that specifically, we did get some employment numbers this morning that
We sure
are
did.
having an effect or are not having an effect on the markets. What are you seeing in that data?
I mean, I think it's pretty positive right now, but I almost feel like this is one of those ones where investors will go and sit on the information over the weekend and come back maybe with a different sentiment next week because the employment numbers were good. So think about what's been happening over the last week. So over the last weeks, there's been a sentiment that the Fed had become successful, that they have reined in inflation, and that they now have to focus on a soft landing, meaning did you do too much correcting and now you have to unwind what you did in order to keep things going without there being a thrusting of the economy into a recession. So having this employment news, I actually put it up on the screen over here for people to take a look at. What it says here is that this month payrolls are up more than expected and more than last month. So they came in just under 200,000. They were expecting 180,000. And well, last month they were 150,000. The unemployment rate is down. So last month it was 3.9%. They expected that to stay the same. It's back down to 3.7%. These, by the way, are two different surveys that go out. So a lot of times this data doesn't correlate, but this time around it looks like that data is correlating. They also are showing that there's an uptick in private payrolls just at expectation, kind of a downturn in manufacturing. And we knew that. We've got a lot of actual materials, like not just raw materials, but finished goods, especially, appliances and furniture, things that you only buy once every like 5 to 10 years. Those things are piling up at warehouses. So you can see here that manufacturing has had a reduction in jobs below expectations. But I like looking at this participation rate number. This is how many people in the states here are actually participating in the workforce. And so seeing this number tick up means that folks who kind of took themselves out of the employment world during the pandemic are now coming back in and getting jobs again. So that's not a bad thing for a functioning economy. But here's the number that people are looking at, and this is the average hourly earnings, right? It had dipped down to 0.2% per month. That means if you extrapolate it over 12 months, that would be 2.4%, kind of right in line with the Fed. Well, this time it came in, expectations were it was going to tick a little bit higher to 0.3 or 3.6% spread out over a year. Came in at 0.4, which is 4.8%. That's a little bit hot for what the Fed is targeting. But at the same time, it gives people like comfort that the Fed didn't go too far and that there's going to be kind of a danger of a recession in the next coming months. So right now, this is being considered good news, but I almost feel like once it sets in that the Fed might have to take more action instead of pull back actions, investors might have a different thought on those employment numbers.
And so, I mean, everything that you just reviewed seems positive. That it seems like the economy is doing better. The market is up on that news, but does that mean that the likelihood of a cut is diminished? And that is that kind of the thought process?
And that all last week when we met on Friday for the AJ Brown show, we had really detected an overall dovishness in the comments of the Fed, but mostly in what investors were perceiving, right? And that's what it's all about. I was trying to tell my folks in my program the other day, I was quizzing them about broad market parameters as well as company parameters. I'm like, does earnings per share for a company actually influence the price, right? And I guess influence is a gray word there. Or does the Fed numbers actually influence what's going on in the S&P 500? Not directly, right? And so you got to get it out of your mind that, hey, this data is black and white and will have a direct effect up or down for the market. What you have to understand is these markets are controlled by investors, by the hive mind. So almost you have to get into your mind of how are the tribe of investors that move the market up and down, how are they perceiving? Because that's really what you have to do. You have to get on the coattails of this hive mind. It's almost, a lot of folks come to me and they're thinking, wow, trading and investing has a lot to do with math and science, when in reality, it has a lot to do with psychology, right? And so that's really what we have to think about. So the dovishness of investors last week has kind of worn off, right? And we've seen bond rates go down. We've seen the price of oil go down. And so money has been kind of coming back in equities. But at the same time, we know that there's a lot of selling pressure at this 4,600 level of the S&P 500. There's a bunch of people who have been ready to take profits for like the last 3 years, and they're first in line to get rid of those S&P 500s and call it quit in the equities market. And so we have to overcome all of that selling and profit taking in order to move the market higher. But yeah, what you were saying with respect to the Fed. So next week, the Fed meets, and we can see here that investors don't expect any move at all. But then coming at the end of January, they meet again. And again, investors don't expect any move at all in January. But come March, if you remember last week, we saw that investors actually, a majority of investors, more than 50%, thought that there would be a rate cut in March. Well, that number has dwindled back, right? We're now less than 50%. We're at 45% of investors think that there's going to be a rate cut coming into May. So we're kind of really going out there. But by May, a majority of investors do expect a rate cut. But in summary, there's been this number of about 1.25% rate cuts for 2024, meaning right now rates are somewhere between 5 and 5.25, 5.5. They're thinking that rates are going to go down to about 4.25 for 2024 by the end of 2024. That number's been cut back. They now believe it's going to drop maybe 1.1%. So the expectation that the Fed is done with its slowing policy changes has kind of been pulled back this week, and that's why we're starting to see maybe a little stall. In addition to that selling pressure, but a stall in the S&P.
Yeah, and when you look at the Fed actions, would you say it's okay to characterize it as like neutral? They've done all the raising, and now we're waiting for the next thing to happen. And unless we get some inflation data, right, some bad inflation data, it does seem like that prediction of some cuts in 2024 makes sense. Um,
I I definitely think that cuts in 2024 are going to happen, but last week we were thinking there would be a lot more cuts, and I think that that's kind of tempering. So it almost feels like the Fed maybe will do some cuts, but I think it's all about waiting and seeing right now. I think everything is pretty much a guess right now. There's no way to forecast.
And the one thing that you did mention was oil, which is very inflationary in a lot of products, services, things of that nature, and we've been
Mm-hmm.
seeing some significant pullback on that side. Do you think that this is having an impact on one, the market, the economy? What are your thoughts on the oil market?
Well, definitely. So, oil, energy in general, and also food products, these things are generally factored out of any decisions that our monetary policy holders, at least here in the States, take into consideration around, right? They try to factor it out because it's very volatile and it's got so many reasons why it may go up and down. So, our Federal Reserve here in the States and a lot of the central banks around the world, they try to factor out energy. But for you and I, when we go to the gas pump, or it's now winter time, so a lot of folks are still heating their homes with fossil fuels, whether they be natural gas or whether they be crude oil. This affects our day to day life. And yeah, oil has pulled back, right? In the beginning of October, oil was up at $90 a barrel. It's down at around $70 a barrel. And, you never know exactly the business decisions of these different oil companies out there. But when you reverse engineer it, you kind of have learned that around the $70 a barrel mark, the fossil fuel companies kind of take the stance that there's no profit in drilling or exploring for more oil at this time, that they should just, keep their business investment every day into the kind of continuing of the current drilling. And then I think that the number is somewhere around $62 a barrel. At $62 a barrel, it really doesn't even make sense for the companies. I'm talking about US companies in US oil fields to even, be focusing on trying to pull out more oil from our planet, from the existing places. They're going to pump what's pumping, but they're not going to, frack any deeper or anything like that. And if it gets down to where it has been sometimes down at the 40, even $30 a level, pretty much business stops because it just doesn't make sense. It's too expensive here in the States to keep the things growing. So it's interesting, what does us well at the gas pump doesn't do the energy sector well here in the States. So $70 is kind of a nice little sweet spot, $70 to $80. When it gets above $80, people start to get upset because it's very expensive just to do the everyday things like get to work and heat your house. So that's where we are right now. We're at the bottom of kind of our sweet spot range, and we're getting into the territory where getting any cheaper than that, it's going to start affecting not so much individuals' pockets, but it's going to start affecting kind of the businesses that run here in the States. So investors' pockets.
Well, personally, I'm happy about oil. I seen the gasoline numbers are following suit. One final note that we have for the market review is bond yields, and
Hmm.
um, is that I know it was more impactful a few weeks ago, but are people still keeping an eye on the bond yields as they were previously, or is it kind of becoming a backstory?
You betcha. You betcha. So there's also another hidden thing. So yeah, bond yields, just like oil prices, have pulled back. They at their peak, they were close to 5%. This is the 10-year treasury bond. They were close to 5%. And now they're pulling back to four and a quarter. I think it's usually about somewhere between 1% and 1.5% that pullback that people start refinancing their mortgages and things like that. So if it goes down, maybe another 0.5% or more, people will you'll start seeing the the refi market start to get kind of exciting. But at the same time, right, the Fed, I always have to remind people that the Fed has been selling these bonds that they bought, right? They bought these bonds to bolster and buoy up the economy during the pandemic. And they've got pretty much, what does it look like? They're down here at about I'm looking really close, $7.8 trillion. They were up at $9 trillion. So they've pretty much sold $1.2 trillion worth of bonds over 2023. They're trying to get down below five, right? So that tells us that they're going to be somewhere in 2025, 2026 before they get that landing, if they can stay at the current sell rate. As they sell these rates, we've seen this thing over this past year where there have been, especially hedge fund investors, buying those bonds anyway, and so yields haven't dropped. But if the Fed continues to sell and we wind up not having as many buyers, that's going to have this interesting effect that we've never seen before, because we've never really done this quantitative loosening, right, versus quantitative tightening. We're now doing quantitative. I'm sorry, I got that backwards. We're now doing the quantitative tightening. And so as we sell back these bonds, we luckily have had buyers of those bonds. But if those buyers dry up, we're gonna start seeing things that we've never encountered and don't really know how to interpret, which is bond yields dropping and maybe even a yield inversion curve that is not naturally created but is artificially created by the Fed selling off these bonds. So that's kind of a red flag that a lot of economists are looking at, even as early as 2024. That would be kind of a mysterious, and most often mysterious means negative thing for the market. So some of our long-term economists are raising red flags on that.
And just to confirm that movement of the bond selling is the shredding of money, essentially, conceptually, meaning that when the
Mhm,
pandemic came around, we created all this money, and over the past
mhm,
year, we've been taking it out of circulation, which
mhm.
going to 9 trillion, I think that's the right thing to do. I think the Fed's actually doing the right thing in that respect.
Yeah, so that's exactly what it is. So the Fed is the only buyer and seller of bonds that the money that they use to buy bonds versus the money that you and I would use to buy bonds. We have to go out and trade our time and earn that money and then invest it into bonds. The Fed can just create the money. So when they were running into a situation during the pandemic where, money stopped circulating, the money stopped moving around the markets, and things were like stagnating, and it was going to create a collapse of the financial markets, because the financial markets totally rely on the fact that we do business with each other, and the fact that we were all at home not doing business. The Fed's answer was to somehow inject money into the markets, and so they did it by different ways, right? They actually did it by reducing interest rates so that people didn't, they could borrow money for free, basically, and not have to, you didn't have to pay that money back with an adder. You could just pay it back without any, 0% financing is what we heard. Anything from like going to Home Depot and buying dryers and washers to buying cars. Even, the mortgage rates were very low, so you could buy a house and not even spend so much on the borrowing of money. But at the same time, right, they needed to inject more money into the economy to keep it going because it really was stagnating. And so what they did is they started basically printing money by buying bonds, and whoever was selling the bond, they would give this money to, and that money would then trickle down into the economy through the investor world. Well, now they're doing the opposite. They're selling these bonds back, and as they get the money for selling something, they're giving it back and shredding it, or they're crossing it off on the IOU accounting ledger. And so by doing that, they're now introducing and sopping up that excess liquidity. But in doing so, unless they have a lot of buyers, they could actually be affecting the bond market. So if they start affecting the bond market too much, they'll either have to slow down their bond selling. I don't know. This is all uncharted territory. And whenever we talk about uncharted territory in history, it usually ends in negativity. So we'll see. We'll see how the Fed deals with this. But you're right. In the long term, it's important that they not have so many IOUs to the U.S. government and to the U.S. economy, for that matter. But in the short term, undoing those IOUs it could be detrimental on the short term and even medium term of our economies.
We'll continue to reference that chart because I know we do it week to
Mhm.
week. But we've got plenty ahead. We are streaming live, so if any of our viewers have a specific question that you want AJ to run through, feel free to throw it into the chat. If we have time, we will get into it. Otherwise, I do want to give everyone a chance. If you haven't had checked out AJ's daily workshop, we just threw the link in the chat. We're going to be going through some options premium selling examples later on in the show, maybe a few different other types of option strategies. I know that sometimes I know last week we talked about vertical spreads and calendar spreads
Mhm.
and the different ways to use options. But if that's sounding a little foreign to you, or you're just getting started in the investing world or options in specifically, this is a great resource, completely free. Head on over to the link. You could watch it today. You could sign up, watch it later next week, watch it over the weekend. That's what it's there for. We're going to go ahead and take a short break. We'll get into a few more chart analysis. We'll go over our topic of the day. We'll get AJ's pick of the week, and we'll run through our speed round. So sit tight. We'll be back in a few seconds. And once again, if you have any questions, throw it into the chat.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, back at it again. Let's go ahead and get your chart up there. AJ, anything specifically in the charts that you want to run through before we hit some of the other topics?
Sure. I was just looking at the intraday chart. These are 15-minute bars on the S&P 500, and it almost looks like, how I just got through saying that this employment information, at least in the beginning, looks positive, but as it sinks in, investors might actually kind of get a deja vu feeling and realize that it might be negative. Well, I'm already seeing that they're already having buyer's remorse, right? They're hitting that 4,600. There's profit taking. I wouldn't be surprised if today ends lower, even though it started off so well. Here's a daily chart, and you can see, I've already counted the December 1st close as our highest close of this current rally. And you just saw that today went negative compared to previous close. It just turned from a green to a red bar. So this December 1st close was our highest close to date. And it's live, folks. And I'm going to throw a quick indicator on here. You've got your arrows, but if I throw on here what those arrows are being calculated from, which is the 3 and 5 day EMA, I'm going to go ahead and put those in right here into this indicator that I just added. You can see, one thing nice about our free retracement confirming indicator is that we have this 1-bar reversal filter, and you can see I have it turned on to yes, because we look for confirmations. And you see right here how yesterday we dipped below the 3 dipped below the 5, and then one day later it popped right back up. Well, we don't like to count that as a confirm, right? We want to see a confirmation of a clear crossing like we have back here on October 18th, or this other crossing back up on October 31st. So these little tests is what we call them, or even for lack of a better name, teases. These little teases don't count for us. And the 1-bar reversal filter helps us not see those. But I wouldn't be surprised if we don't, after this little tease, get our full-on crossing, and that this top that we identified here back on December 1st is that top. And you can see I've already, in my world, already counted it as the top, even though it hasn't been confirmed. And so you can see I've drawn in our next targets. And last week I said the next target is going to be critical. And so now you can see it actually in my graph in its drawings. If we pull back to this level between about 4,300 and 4,412, if we pull back to somewhere in that magenta zone that I've drawn and then start heading up, that would tell me that we're in for a nice uptrending. That would create a mature uptrending market, one with 2 levels of tests of support, 2 levels of test of resistance. And I would say to you, hey, we're going to be uptrending for the foreseeable future, right? Midterm, even into long term. If instead we pull back to this red zone, somewhere between 4,005 to 4,300, anywhere where we pull back there and then head higher, I'm going to tell you that, hey, it's sideways choppy for the foreseeable future. We've got a mature sideways choppy kind of trend, and so it's going to be kind of undecided going into 2024. And should we fall down below $4,005 into this green zone, I'm going to tell you that, hey, we had this rally from October 26th up to December 1st, but that was a little flash in the pan, and that we're now going to be starting to get back into that downtrend, the downtrend that we started on July 7th and took a brief pause from on October 27th. We're going to resume that downtrend. So where we fall in the next weeks for the next reversal is going to be critical for my analysis moving forward.
Yeah, and if you're a directional trader, hearing AJ say sideways choppy, then now is the time to think about using options to take advantage of that
Absolutely
trend, which is something that we do on a week-to-week basis. But before we go into some of the options, your pick of the week, or some of the option strategies, I do want to touch on maybe an extension of what you just covered, and that's our topic of the is what indicators help analyze the broad market. I know we just went through the MACD. I know that you've got your custom, I don't know if we've ever come up with a name for it, but your custom arrows indicator. There are other things that one should be looking at to help analyze the overall broad market.
Yeah, well, so the scoop is that, and I got these questions because, gosh, it would be so nice, wouldn't it, if there was just one indicator that told us when things were at their highest and when things were at their lowest. It would be just so nice if there was some sort of magic indicator. Who cares how it's calculated, but it was just one that would tell us tops and bottoms that we could trade low, buy low, sell high, or sell high and buy back low, and it would always work. And if that existed, guess what? We'd see a lot more traders and investors out there, and everybody would be rich. Now, we know that that's not the case. We know that in the broad markets and in the markets, the majority of money flows to those market movers. And that's because they're just really good at this game versus some of the newbies, right? And a lot of newbies, if they don't have the staying power and they also don't have the guidance to learn how to do this right from somebody who's successful and who can teach them, then they often find that they give money over to those people who are more experienced than them, right? And so the scoop is it's not as easy as one indicator out there. Now, we have our confirming indicator that we give people for free. It's nothing more than a lag, and I just updated the wrong one. It's nothing more than a lagging indicator identifier. For some reason, I can't even click on the one that I'm trying to get on. Let me get rid of some of my drawings here, and I'll click on this. All this is a confirming indicator. It's a lagging indicator. And most indicators that identify reversals with any sort of accuracy are based on a lagging indicator versus a leading indicator. Leading indicators kind of are very speculative. They're based on the premise that things can become overbought and oversold. Only problem with that is often that threshold for being overbought is a fluid threshold. So where it was overbought 2 weeks ago doesn't necessarily mean it's overbought now. Same with being oversold. So leading indicators haven't proven to be successful top and bottom finders or reliable top and bottom finders in the math world, right? Combining a leading indicator and a lagging indicator, there's some promise there, and a lot of swing traders use that combination. What we've got in our little free indicator is just simple lagging indicators that you can use to identify tops and bottoms, either based on moving average crossings or on MACD crossings, and we give you the flexibility to decide which price is used in the calculation. So if you just want to use the basic close price, you can. If you want to include some historical volatility, you can use the high-low close divided by 3 or even the open high-low close divided by 4. I have been playing around a lot with the volume weighted average price to throw some volume calculations in there. And, you can set all your different parameters on those lagging indicators. Plus, we've got our 1-bar reversal filter in there. And we're always adding functionality. We're playing around with functionality for this free indicator to make it even more configurable. The answer is, right, a lot of people have brought up to me that, hey, when you look at the broad market, you use the 3 and 5 day moving average, exponential moving average crossing with your 1-bar filter. But it seems like a lot of times when you're trading, and I'll show you, I've actually got my indicator added twice. So if I switch off the one that I use for looking at the broad market and I switch on the one that I use for actually looking for trading signals, you can see that this is a MACD instead of a moving average crossing. It's based on volume weighted average price instead of closing prices. And these are the parameters given to us by the mathematicians behind the MACD. This is what we call the fast MACD settings. And I don't turn on my filter in this case because I want my indicator to give me the fastest responses possible. And a lot of times with a filter, you have to let a day or two or a bar or two go by before the filter is satisfied. So I turn it off, right? And so that gives me a little bit more responsive indicator for identified tops and bottoms so I can get into my trades faster or slower. How do I decide what settings for my different indicators? That's the whole premise behind backtesting, right? Backtesting allows us to try these different combinations on a pattern, the bars that are already set, where we can actually see, thanks to hindsight, what was a top and what was a bottom. And we can see where the indicator actually identified tops and bottoms, where it missed, and where it falsely identified tops and bottoms. And we can fit, the indicator, we can try out the indicators on past data to see which one is the best fit. And then we can use that indicator moving forward, knowing that once we identify something that says the pattern is now broken, that we would stop using it. That's one of the key things that people do wrong, is they don't know when their pattern has stopped. But that's how I decide which confirming indicator I'm going to use for my trade signals versus which ones I'm using for my broad market. For my market, it tends to be slower, like the 3 and 5 EMA crossing. For my trading, it tends to be faster. I like to use the fast MACD. I think that that's a really good one. I like to use the Shaken oscillator. I like to use trend directions, things like that. So that kind of gives you an idea. There's not one answer for every single pattern you identify. You have to pattern fit. If it was super duper easy to be a successful trader, I'm telling you, everybody would do it, right? So you have to wrap your mind about it and stop struggling and stop, knocking on people's doors and stop chasing shiny objects, believing that there's one simple answer that you can apply to everything. And instead, resolve yourself to embrace your mind, to wrap your mind around the topic and just get good at it, right? Just get good at pattern fitting and learning which indicator works with which symbol, and go forth and conquer. That's my spiel.
I would probably add a little bit of risk analysis
Always.
or assessment to that. And anybody that's downloaded or logged into a trading software and went over to that indicator section might be overwhelmed, because there's so many to choose from. A lot of them do the same things. A lot of them are telling you.
Look at this listing built in.
Exactly.
Look at this listing just built into the trading software that I've got. These are ones that, there's a bazillion, right? So I try to, at least with my program participants, narrow it down to, 3 or 4 that I have found that work. And then you just have to pattern fit. But don't believe, and if somebody tells you that they have the indicator that's going to always work, I would just use your common sense and use what I've said today. If it was that easy that you could pay somebody even $100 or even $1,000 or $10,000, and you would have the answer to make you a successful trader, if it was that easy, everybody would be doing it. And as you probably know, very few people are successful traders and investors. And it's those people who have sat down and just wrapped their mind around the topic and then practiced. It's like building a skill. There's no secret. I don't have, SIP, a red and a blue pill that if somebody gives me, $497, I'd give them the correct pill and they'd all of a sudden become an expert trader. You're going to have to sit down and wrap your mind around the topic, right?
The one thing that I always like to think about is if you're investing or trading for the first time and you are successful in winning, that means that somebody's in order for you to win, somebody has to lose. And if you think you're always going to win and everyone's going to lose, that's just not the reality of it. Which is why we have the show, which is why you created Trading Trainer, which is why you have your community meetup every Thursday where the members come on board and talk about what they're doing. You give your perception. You guys figure out potential trades, investments, and some people pull the trigger, some don't, some people watch. And that's the beauty of it. Every day the market's open, there's opportunities, and there's strategies, there's approaches, which is what we're going to go through the rest of the show. We're going to get your pick of the week, and then we're going to go into the speed round. So last week's pick of the week was Meta.
Mm-hmm.
This week's pick of the week is something that we've discussed a few times, and that's the financial sector, and that's XLF.
Mm-hmm.
What are you looking to do here,
Well,
AJ?
we actually featured this 2 weeks ago. This was my pick of the week 2 weeks ago. I'm revisiting it because 2 weeks ago we were waiting for a signal. We got our signal. This is an end of day signal, everybody. That means you get the signal after the market's closed, and then you try to trade the signal on the subsequent days. And we just didn't get the follow through on the 2 subsequent days to get the trade to fill before we got a negate to that signal. But we did get the signal again just on a Tuesday of this week. So again, end of day signal. So Tuesday evening after the market closed, we got that signal. And guess what? Wednesday, we got clear indication to go ahead and short either the XLF stock or buy a back month deep in the money, far out in time. And I think that we were actually looking at the September option. Let me just verify. Yeah, the September 20th, 2024 option is the one that we wound up going with, and shorting that guy in order to set up our trade. Now, the scoop is we've actually had a couple stall days since then, but I think we're still good to go. But for anybody who missed that trade, you still have that opportunity. So if you're dealing with a margin account, you could definitely short some XLF. If you're dealing with a cash account, you might consider buying that deep in the money, far out in time put option. That's going to act as what we call a option trading at parity. So it's a substitute for shorting the stock. They move dollar for dollar opposite each other. So if XLF drops $1, that put option goes up $1. So it acts just like this. And that's a great substitute because then we're set up for wherever we find the next reversal up to sell put premium and buy our protective calls and start creating an income position. We actually featured this one on our program last night, our workshop with our program participants. Usually I don't like to share that with the general public, but we talked about this 2 weeks ago, and I just want to let people know that the signal was found on Wednesday, and it still looks like there might be some opportunities for us to think about this. If you're new to this, paper trade it, simulate it, see if I'm right with how we like to proceed with these XLF, and then get into the move of going forward on this. So this is where we're at with XLF.
And just a quick follow-up question. If you were, or if you did, or if someone on in the community did take that position, what's the time frame that you're looking at to potentially make an exit?
Well, the last time that we got some signals, let's look at this one, about 1 week, 2 weeks, 3 weeks, 4 weeks. Over here, we're talking about 1 week, 2 weeks, just 2.5 weeks. And I wouldn't be exiting per se. Instead, what I would be doing is selling put premium. So in this case, selling the front month near term at the money put, and that's going to generate an instant dividend. That's going to generate some instant income for us. And I like to use that instant income to help offset the price of a protective call, which will then also profit for me as well as offer me protection. So, that's kind of my next move. My next move is to sell premium, buy protection. And this is going to create this cycle. My idea, Sip, and this is a little bit different than a lot of folks think about, is instead of trying to have winners and losers, I'm letting the fact that options profit over time, right? Especially if you sell those options. And so what I want to do is I want to stay in this position as long as I can. Number one, because I know at a certain point, my position will appreciate enough. I will have collected enough, instant dividends and rollouts from the protective option to have brought my break-even price below my protection price, below my stop loss order, below my protective option strike price. And so that means that was a lot of word salad, I know, but that means that my trade very early in its life cycle becomes risk-free. It means that even if the position goes against the direction that I've traded, I'm still going to make money, right? Because my insurance, my stop loss order gets me out at a profit. So that's my goal, is to stay number one in the position long enough for it to be risk-free, which usually means about 3 to 5 weeks, right? And then after that, who cares where the stock goes? Because either way, whether it goes in the direction I expected it to or against me, I'm still going to win, right? I'm still going to. So people are always like, well, what's your win-loss ratio? Well, so long as my position lasts past the first cycle, that's all winners. So the key is to just get past that first cycle. So that's my goal. My goal is, number one, to get to the point where the trade is risk-free. But number two, the longer I stay in the same positions, making these monthly adjustments to the position, adding a position here, taking a trade here, adding, taking away, the longer I can stay in that initial position, my profits for the position, instead of going up linearly like most trades do, they go up exponentially. So if I can stay in there 5, 6, 7, 8 months, I mean, I could be doubling my money in as little as 5, 6, 7, 8 months, right? That's unheard of in these type of investments where you do these little monthly positions, right? They're very effortless, and yet the payback is often. So my goal, number one, get a risk-free trade as quickly as possible. Number two, have it last as long as possible so I can get those exponential gains.
All right. That's XLF, AJ's pick of the week today. AJ's pick of the week of 2 weeks ago. Got a nice little signal there. We'll keep an eye on it. I believe the notes say let's revisit a name from last week, maybe the week before. This is Zoom, ticker symbol ZM. Follow through.
Well, yeah. So what I wanted to say here is Zoom, outsmarted they outsmarted our statistics. Our statistics said that Zoom was not going to come back across this channel from 64.50 up to 73.75. It had gotten too low, and our statistics said, hey, once it gets that low, the chance that it's going to actually not only come back to the channel, but cross the channel, like you can see it actually did, was less than 4% chance. So Zoom, what against all odds did what we didn't expect it to do. And so we're actually looking for Zoom to top out. And I wanted to just bring people's attention back to Zoom. Look for where it's going to top out, and you could be setting yourself up again. Nice trade for selling put premium against. So we'll probably revisit this in the future weeks, but I wanted to outline that every once in a while there's a candidate that beats all the odds, and Zoom did that.
Yeah, and with the broad market hitting that 46 level, and if your indicator were to give us a little pink arrow, then that would definitely set us up for a nice little short position.
You're getting it, man. You're getting it.
Well, 110 episodes, I better get it at this point. All right, that's Zoom and AJ's pick of the week, XLF. And as you know, throughout the week, AJ has some wonderful workshops. He's getting setting up calls, having conversations with people all around the world. And throughout that process, they're asking some names. They're asking for some input on some tickers. And so in this part of the show, that's where we review those. And so for our speed round, let's go ahead and start with Cindy from Cleveland, Ohio, who's interested in retail name TJX Companies, ticker symbol TJX, which I'm interested in because we did talk about retail being hot this time of year. This is kind of one of those names. What do we got? What do you see?
Well, TJX, that's the holding company for things like, I think it's Home Goods, TJ Maxx, Marshalls, all those kind of. They're not the Nordstroms and Saks Fifth Avenues of the world, but a lot of people do like to shop there. They get overstock and get quite a few deals there. Here's my issue with TJX. This is what we call a consolidation pattern, right? You've got a descending line of resistance. Maybe you have a straight, slightly ascending line of support. This is coming into a point. And what that usually tells us, again, putting our feet into the shoes of the investors who are investing in this stock, is that they're a little bit uncertain. They're confused. They don't know whether to buy or sell. So they're kind of sitting on their hands. And they're starting to get nervous. They're wondering, should I buy? Should I sell? And it's been going on like this for almost 2.5 months. And so, the investors are probably quite antsy at this point. And any sort of news that 2.5 months ago they would have just brushed off as just news might be that kind of tinder to light them off to start buying or selling. In other words, this is the type of pattern that can create a really nice breakout. Whether it be a breakout up or a breakout down is yet to be seen, but it usually means that the pattern is not going to stay at its current level much longer, especially if more pressure builds as we consolidate and converge within the month of December and into January. I wouldn't be surprised if right after the holiday buying season, if this thing doesn't break out in one direction or another as they report kind of their results of the holiday season. So with that said, we don't want to trade any sort of range bound strategy on this, any strategy that profits on the idea that it'll stay within a certain range, because all the signs seem to be pointing at this guy not wanting to stay in a certain range. So you should change your attitude and perhaps look for strategies that profit on breakouts. We're talking about, if it's just a implied volatility rush or crush, you're thinking about maybe a horizontal spread of sorts. If you're thinking about actual price action, you're thinking straddle or strangle. Or you could use an active buying strategy, find a way to detect the breakout and then either go long or short the stock, or go long or short a leveraged option. Those are all ways to trade this, but I don't think I would turn this into a premium trade. There's just too much consolidation going on right now on TJX.
All right, that's TJX. Thank you for that, Cindy. Moving on to our next name. This is Mark from Charleston, South Carolina, interested in Advanced Auto Parts, ticker symbol AAP. What's the scoop there, AJ?
All right, Advanced Auto Parts is an interesting little guy, isn't he? I'm going to get rid of some of this this extra indicator here. We'll just turn him off for now. So what I'm seeing here is a pattern that perhaps is maturing into something else. We had about 3.5 months of downtrend, but now we've got 2 tests of support, and it looks like we're coming up with 1 or 2 tests of resistance, telling us that we are in a sideways channel. So I'm guessing that Mark from Charleston is perhaps seeing the same thing, that we're in this sideways channel. Sideways channels are my favorite for trading premium. I'm going to sneeze. Maybe not. Now that I said something, it's not going to happen. I'm looking over here at my fast MACD signals, and this would be one of those cases where I might go back and try some different confirming indicators besides just the fast MACD. I'll try some other ones to see if I can get a better signal of tops and bottoms. But besides that, I think you might be onto something here. It looks like we identified some sort of level of support at $50, some sort of level of resistance at $58. So if I were you, Mark, I would plan out my trade. I would, have a rules-based approach about when I would buy or short in order to set up my initial position, and then when I would, sell the premium and buy the protection. and have that written down, and also take a moment and evaluate your risk, which you can then translate into position sizing, as well as giving yourself an additional criteria in your trade plan, which is besides identifying when there would be a good opportunity for buying and selling, making sure that there's a price target in place so you can keep your risk appetite satiated. So yeah, I like it. I think that there's some planning that you have to do this weekend in order to make this successful. And luckily, you've got a couple of days of movement here before a top is found. So take those days to plan this trade out. And I would definitely do some back testing on confirming indicators. And I would actually do what I call forward testing or paper trading. Once you've got your trade plan and you've got the indicators you're going to be watching, why don't you try trading them in your simulator or paper account, see how it plays out for a cycle. And if it works, great. Switch over to real money. If it doesn't work, well, then no harm, no foul.
All right. AAP, keeping an eye out to see if anything follows through over the next couple of days, weeks or so. So thank you for that, Mark. Moving on to our third and final name of the segment. This is Eric from Calgary, Alberta, Canada, interested in metals name Eldorado Gold, ticker symbol EGO.
I mean, we have featured this in the past. You can see that we were in a sideways channel. So, Eric, I don't know where you are in this trade, but this one changed personalities. It started to uptrend. As you can see here, we were looking for that opportune point in order to do our transaction. If we were, for instance, long Eldorado Gold, then right here when we got our end of day signal and then our follow through the next day on October 26th, we would have sold a call only to be surprised the next day with this price gain, and we would probably do our best to get out of that position. In other words, buy back the premium, sell back the protective option, and now we're just long this stock. We got another signal. That would be another, depending on how you interpreted it, because it was outside of that 140% zone, this might have been a sell signal for you, right? And if you sold here, great. If you sold more premium, guess what? You got out again of that premium trade. So we've had two false starts, all because the symbol was basically telling us, hey, I'm done going sideways. I'm going to go up. So if you sold here and then you took this buy signal, this has basically become into a swing trade, right? This is no longer something that you would sell premium on. It's changed its personality and it's become a trend follower, and it's a mature trend. And when I say that, it's because I've got two tests of ascending support. Here's one. Uh-oh. There we go. Here's one. Here's another. And I've got more than two tests. Well, I've got a minimum of two tests of ascending resistance. And so I've got this here channel that has formed. There's my resistance level. Here's my support level. So this is considered a mature trend at this point. And so the way that I would trade this is like a swing trade. So I'm currently getting pullback. As soon as I'm done pulling back, I would try to trade directionally, whether I use just the stock or I go and I use a leveraged option. So I use like a 6-month out deep in the money option. Or if I'm really elegant with options, I could try to trade at the money or slightly out of the money options to take advantage of the parabolic price curve. That gets really into some strategy. If you're a newbie out this, just go with the substitute. But man, this is a textbook swing trade. But anybody who is still trying to trade Eldorado Gold as a premium selling position, the key thing that you missed is that this has been telling us for a while now, since about November 3rd. So over a month now, it's been telling us I'm no longer trading sideways. Stop using sideways trading strategies to profit from me, because that's not, you're missing, the pattern observation here.
All right. Thank you for that, Eric. Eldorado Gold priced very well too. Looks like 12.52 right now, something like that. So can definitely get creative with the different types of options without having to have a massive investing account. So love the call out. Thank you for that, Eric. All right, heading into the end of the show here, AJ. Thank you to everyone who threw out some of these speed round names. AJ's pick of the week. We've only got about 3 weeks left in the year, AJ. I know that I'm looking at the market now, and we're almost at break even for the day, where we went and we almost practically tested that 46 and pulled back. So what should we be keeping an eye on? What are you looking at going into next week? Any thoughts, any advice, or final words?
Well, yeah, we're still in a situation of transition. And so, like I had shown you guys in the beginning of the program, where we reverse next is going to give us a lot of insights. But until we get there, you have to be very careful about how you're doing your trading, because these broad market forces buoy our individual positions up and down. So we may have analyzed to heck and had thought that we had an understanding of the pattern of an individual position. And you're right, you did it all right. But if we have a broad market in position in transition, then this individual position can get all squirrely on us, right? The tides will bring something up or down against our control. So the key right now, while the market is still waiting to tell us and waiting to mature into its final final expression of its new direction, while we're waiting for that, don't trade long term, right? Instead, take as much profits as you can from each trade up front, because you never know what's going to happen even a month from now. We trade what we see, and what we see is transition. And so we need to be thinking, get as much money in the short term. Don't worry about going for the long term, despite that being the ideal situation. Ideal or not, that's not what the market is presenting us right now. That hasn't been what the market has been presenting us since the last few days of October. So we need to be just a couple of weeks here that we're in transition. Get your profits up front.
Yeah, and I could imagine next week being a little bit more active, but the week after, the week right before Christmas, and then the week after that, is Christmas. I could see the volumes being down, erratic movements, not really showcasing the true nature of the market.
No.
So we'll keep an eye on that. Otherwise, create your trade zones, sit on the sidelines, do some paper trading. Organize your indicators, create your watch lists, things like that. Will certainly get you prepared for a solid 2024 start to 2024. So, AJ, thank you again for your time. I want to thank everybody for tuning in. As always, if you have any questions, feel free to leave us a comment. Feel free to send us a DM. You can head on over to tradingtrainer.com, ask a question there. Get in on the free resource section there, because I know there's a slew of wonderful tools there. If you've enjoyed the broadcast, hit that like, hit that follow, hit that subscribe button. Otherwise, we'll catch you guys next week.
Hope you feel better, Sip.
I'm working on it. All right, guys. We'll see you next week. Take care, everybody.
Bye.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about his investing tech, and create your free today. And And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.